I'm joined from Dubai by Deepa Sachanandani, Head of Research at Century Financial. Deepa, good morning. Thank you for joining me this morning. Is it the type of the way ad is being shown? Is it the target audience, or is it what restrictions that Apple imposed on apps tracking what caused that decline in the shares of Google and Meta in the ad business?
Like we've seen, the Federal Reserve has gone for multiple rate hikes last year, and there has been, of course, recession fears that are there in the market out there because of the rate hikes. So, growth stocks have taken a beating last year compared to value stocks, and Apple, Google, Facebook, for that matter, and obviously Meta and Google have taken the repercussions for the same, because when we see the yields on 10-year bonds go up, that is definitely a big negative for growth stocks. So that is what has been the primary factor responsible for the sell-off that we've seen in major large cap tech stocks last year.
This decline in company shares you mentioned, is it also in anticipation of a decline in the revenues of those companies, which is the result of weakness of digital ads on those platforms, like we said?
Right, definitely. When we are expecting a slowdown in the economy, so the amount that marketing companies would spend on their advertisements, the expenditure, the budgets would also decline. So markets are expecting a slowdown in the revenues for Google, for advertising companies like Google. So that will have an impact on their top line as well as bottom line to some extent. And also it is also an impact of what happened back in 2020, wherein people there was a huge influx and the world shifted towards technology, but that is shifting and we are not seeing the same kind of growth that we saw in 2020. So that impact is also there for technology stocks, which is taking a beating on both sides, one the rate hikes and the expected slowdown.
Deepa, in the face of those challenges, let me ask you about allocation in the portfolio between equities in the US in terms of growth and value or cyclical. What is your advice for the makeup of the portfolio allocation?
So I feel a lot allocation should certainly be towards defensive stocks and value stocks. Now the problem with cyclical stocks is cyclical stocks also move in line with the economy. So if we happen to see a slowdown in the economy, which we will see in the latter half of 2023, so that's when cyclical stocks will also start taking a beating. So I feel we need to, for the first half of the year, we can have more focus on defensive and cyclical stocks and very minimal exposure to growth stocks, and a ladder approach wherein we are going for investment in phases would make more sense. So once we see growth stocks fall down much to a greater extent, and once we see the corporates start cutting down on their exposure for the growth companies, for even for the earnings for these growth stocks, that's when we can start increasing the exposure towards the tech stocks, because currently that's still not priced in into the markets completely. So I feel a major chunk, around say 40%, should go to defensive. Another 30 to 40% should go to defensive, 30 to 40% should go to cyclical stocks, and only 20% should be towards growth stocks at the moment. In fact, in the
If we keep
portfolio,
30-40%, if once again, if let me continue the question, sorry, and then we can link the two answers. If we keep 30-40% in defensive and only 20% to growth, if we add to that portfolio some fixed income and bonds, how will the make up or division between bonds and equities?
Currently, that's what that I was just coming to that. So this was just for equities, how your equity should look like. We need to have a significant exposure to fixed income as well, especially treasury notes in the US. They're offering close to 4 to 5%. So that's a very good yield at the moment. So I believe we should have a significant exposure to bonds and less exposure to equities. So in the current scenario, a 60-40 is something that would do well. For conservative clients, you can even go for a 50-50 allocation, wherein you're looking at 50% in bonds and 50% in equities. And within equity space, then I said the allocation could be 40-40-20.
Deepa Sachanandani, thank you so much for having joined me this morning.
Thank you so much.